Good morning and welcome to day 29 of 30 for the fall 2022 semester for financial accounting. Today is our last day of new material. We'll be finishing up chapter 14. And so the chapter 14 exercises should be ready to submit by the end of the day today. Tuesday is day 30, which is officially a class day, but as you've heard, we're not having on-campus face-to-face class because that will be our review session. And so that will be on Zoom. I will not be on campus. I will be on the Olean campus on Tuesday. So if you do need anything, certainly I'm available. And during class, we will use the Zoom link for class that is located right in Brightspace. So you don't need to, unlike the other review sessions that we've had this semester, you don't need to sign up in Starfish or anything else. Just if you choose to come, use the Zoom link for class. We'll start right at 10:15, and I would anticipate going through the practice set for the exam. We'll take a look at that today. We didn't look at the exam on Tuesday, right? So we'll take a look at the practice set and the exam today and talk about anything we need to talk about. First thing, though, is to finish up the chapter 14 exercises. So next Friday is the last day of the semester. It is the last day to submit any work that you want included in your final grade after Friday, December 16th. Anything that has not been submitted for grading through Brightspace, through Cengage or in Brightspace will become a 0. And so keep that in mind. If there are assignments that you've missed throughout the semester, everything remains open and can still be completed, but none of that you may have missed, none of that right now is being included in your grade at all. And so if you do have assignments that you have not completed throughout the semester, those will become a 0, and that can only bring your grade down. So please make sure you submit anything that you want included in your grade no later than next Friday, ideally earlier than that. Next Friday, then your last exam covering chapters 12, 13, and 14 is due by the end of the day, as well as the final part of the project. And final grades for the semester are due on Monday the 19th. So anything that's submitted by Friday, I will have completed by Monday, and those will be reflected in your final grade. As you can see for that final part of the project, once again, the book has indicated which corporation it wants you to use for each one of the 3 chapters. So for this project, you will not be using the company that you chose at the beginning of the semester. You will use only the companies that are named here. So Alphabet Inc., which I assume you probably know is Google, and then National Beverage Corporation, and finally Walt Disney. So any questions about what we have left? We have very little left to do here. Everybody's good? Okay. Then, without any further ado, let's go to exercise 7. And exercise 7 deals with inventory analysis. So this is information that we covered back in chapter 6 on inventories. At the time, we talked about the importance of managing our inventory so that we have enough inventory to meet customer demand, but we don't have so much inventory that it is being, going stale, going out of fashion. At a minimum, we have those inventory carrying costs because we had to pay for the inventory, we have to store the inventory, we have to protect the inventory, and all of that takes time and money for the company. And so having the right amount of inventory is really critical to the management of the company. And so one way of evaluating that is the computation inventory turnover and then the related measure days sales in inventory. Again, we covered both of those in chapter 6, but we're bringing it back in chapter 14 because it's all important to the overall analysis of our company. So as we said on Tuesday, really the point of this chapter is to get you to see really that big picture of how the company's doing. And there's no one single measure that's going to answer all of those questions for us. So we're trying to fit in all of the things that we've covered in earlier chapters, plus some additional information that we did on Tuesday, like vertical analysis, horizontal analysis, common size financial statements. But hopefully all of this, covering all at one time, is helping you to see how each one of these pieces of information fills in the gaps in the puzzle, the answering the decision-making about our company. And so you can ignore the example at the bottom of the screen. We are going to be looking at, I want you to just see the formula there for inventory turnover. So you may want to make a note of that in your head or in your notes. Inventory turnover is the cost of goods sold. So that comes, of course, from the income statement. That's the representation of how much inventory went through our books throughout the year. And then we divide that by average inventory, which of course is the beginning and ending balance added together and divided by 2. The book shows you a different calculation for days inventory on hand. And I'm going to, theirs is just more complicated, unnecessarily complicated. And so I'm just going to give you just as we did in chapter 6, a simplified formula that doesn't require us to do a whole separate calculation. So let's go to exercise 7. And we'll be using that formula for inventory turnover, cost of goods sold divided by average inventory. The following data were extracted from the income statement of Keever Incorporated. We can see their sales, which of course comes from their income statement, beginning inventories, cost of goods sold, and ending inventories. For each year, we are asked to find first the inventory turnover and then the days sales and inventory, and round interim calculations to the nearest dollar, final answers to 1 decimal place. So inventory turnover is expressed as a number of times. And get my annotation function open here. Probably detected throughout the semester. It has to be opened and then closed so that I can, because I can't write in Cengage when I have the Zoom annotation tools open. It's not very helpful. So I think we'll start with the average inventory. And so for the current year, the average inventory would be the beginning inventory plus the ending inventory. You can see that the inventory went up during the year. As we pointed out on Tuesday when we talked about receivables turnover, we don't have any additional information. Well, I guess we do have the quarterlies we could use, but that's a little bit more complicated. The company is not required to provide a great deal of detail about how their inventories have fluctuated throughout the year. And so as an outsider to the company, the information that we have access to is the information that's on their general purpose financial statements that they're required to prepare and share with the public. So we don't know that this is completely 100% accurate as far as a daily inventory balance or anything like that, but it's the best we can do with the information that we have. And so we take the beginning and ending balances, add those together and divide by 2. That gives us our average inventory. We can then find the inventory turnover by taking our cost of goods sold. So during the year, we sold a total of $9,270,000 worth of inventory. And at any given time, we had, our estimate is, we had available $1,030,000 worth of inventory to sell. So 9270 divided by 1030 gives us an inventory of 9.0 because it tells us to round to one decimal place. And as I said, we express inventory turnover as the number of times. One way of interpreting this on any, throughout the year, we sell through our entire inventory on average 9 times. Does that mean that every single item that we carry has been sold out 9 times? No. There are going to be some items that sell more quickly and other items that sell more slowly. But on average, we sell through our entire inventory 9 times a year. If you're not sure what I mean by that, some are selling more quickly and more slowly. Think about a grocery store. You know, the produce section, the dairy section, those items sell much more quickly than maybe the canned good aisle, right? The cereal, things like that. As I told you, the textbook gives us a more complicated calculation for days sales and inventory. I'm really unclear why they do that. If you weren't calculating inventory turnover first, you could use I guess that's one advantage of their formula for days sales and inventory. And I'm not even giving you that formula. If you're interested, you can look it up in the book. But as long as we're calculating inventory turnover first, the days sales and inventory days sales and inventory calculation is much simpler than the way they would have you do it. The only advantage I can see to the formula the book provides is that it can be calculated directly without having to calculate inventory turnover first. But the fact is, we already have our inventory turnover, and so we might as well use what we have rather than making it more unnecessarily complicated. So to find our days sales and inventory, the fastest way to do that is to just take our inventory turnover and divide it into 365 days in a year. 365 divided by 9, we're asked to round to the nearest one decimal place. And so 40.6, and I should have put a label on there, 40.6 days. So a couple different ways of interpreting that number. On average, it takes us 40.6 days to sell our inventory. Or another way of thinking about that is at any given time, on average, we have about 40.6 days worth of inventory on hand. In other words, on average, we can, even if we didn't buy any new inventory, we could support our sales for 40.6 days. So all of those are valid ways of thinking about what that number means to us. So is 40.6 days good or bad? I have no idea. I have no idea what Keever Incorporated does, what they sell. If they are a grocery store, that inventory turnover is pretty slow. If they are a merchandising company, a department store like Kohl's or JCPenney, that's probably a little bit fast. So we need to know, as we've said before, we need to have some standard of comparison. We need to say, is 40.6 days good or bad compared to this other thing? And so for this exercise, our comparison is going to be, I don't know, what was their inventory turnover last year? So if you haven't already done it while I'm talking away, please go ahead and calculate their inventory turnover and days inventory for the previous year. So to calculate their inventory turnover, I found the average inventory beginning of 860 plus ending of 940 gives us an average inventory of $900,000 throughout the year. Divide that into the $10,800,000 cost of goods sold, and we found an inventory turnover of 12 times per year. If we're doing something 12 times a year, it means it's about once a month, right? And that translates into 30.4 days sales in inventory. So now we have something we can compare that 40.6 to, and we can see, to answer the questions from part B, the inventory position of the business has deteriorated. It's taking them an extra 10 plus days to sell their inventory. From a liquidity standpoint, that's not a good thing. They're holding on to their inventory for 10 additional days. That means 10 additional days that they've already paid their supplier, and the inventory sitting there in their, in their store or whatever, and not improving in quality and incurring inventory carrying costs. The inventory turnover has decreased while the days sales in inventory have increased. And as we know, just like we talked about with the receivables turnover on Tuesday, there's of course always going to be an inverse relationship between those two values. One is going up, the other one must be going down. And we can see that in the formula that I provided down here. It's not as evident in the formula that the book provides. But in my formula down here at the bottom, when we put inventory turnover in the denominator of the days sales and inventory calculation, that tells us that they have to be inverse related. So what's happened to the sales volume? So now, in case you're wondering, why did they tell us sales? That didn't figure in here at all. Well, now to answer this question, to do our analysis of the company, we can see why knowing something about the sales volume is helpful to give us a more complete picture of what's going on with their inventory. Why did their inventory turnover go down? Well, their sales decreased. So they may have kept ordering at the same rate and not selling it as quickly. Their inventories increased throughout the year. They may have kept ordering from their suppliers or producing, if they're a manufacturer, the same quantity of inventory until they noticed that their sales were slowing down. So the sales volume has declined faster than the inventory, resulting in a deteriorating inventory position. And so all of that helps us see what's happening maybe with this company. Maybe the maybe the economy slowed down, and it just takes a while to recognize that. The recognition lag, if you've taken economics, that term may sound familiar to you. So sometimes it takes us a bit of time to recognize that, hey, people aren't buying as much. I guess we better not continue producing as much, or we might need to stop ordering as much from our suppliers until we get caught up. And so it's one of the issues, not to get too far afield, but that's one of the issues with economic recovery, is usually when the economy starts slowing down, we see this inventory buildup, like what is happening for Kiever Incorporated here in this exercise. And when the economy starts to pick up, the first thing that happens is businesses are able to sell down those inventories, get them back down to the prior levels. And so even as the economy picks up, we may not see an increase in hiring. We don't see an increase in production because we're busy selling off the buildup of inventories that was unintentional as the economy started to slow down. Any questions about inventory turnover, how we might read that, what kind of decision-making it can help with? All right, we'll keep going then. So as we move on to our next learning objective, analyzing solvency. So we talked about on Tuesday that we are typically looking at how's a company doing in a few different areas: liquidity, profitability. Now we're looking at solvency, sometimes referred to as long-term solvency, ability to stay healthy, to pay their long-term debts, and a couple other areas that we might look at that are not covered in this chapter, but just to kind of give you the full picture. A couple other areas that might be of interest to decision makers, depending on what type of decisions that they're making, include things like market strength. So how is the company's stock doing? That includes price to earnings ratio and a dividends yield calculation. And we might also look at cash generating. And we talked about the cash generating efficiency in chapter 13 in our last chapter. We did a calculation for free cash flow, but I also mentioned during class the concept of cash flow yield, relating our operating cash flows to net income. And we might also want to know how those operating cash flows stack up to the assets that we have available and to our income, our net income. But in this next learning objective, we're going to be looking at solvency. So we have a few different ratios we're going to be looking at in our next exercise. Ratio of fixed assets, so that's the property, plant, and equipment part, to long-term liabilities. Ratio of liabilities to stockholders' equity, also known as the debt to equity ratio, and then times interest earned. So all of these give us a little bit different picture. They're relating something from something related to our long-term liabilities or our liabilities in general to some other aspect of the company to give us a sense of how stable or how solvent this company is for the long term. So looking at our ratio of fixed assets to long-term liabilities, these of course are both going to be balance sheet measures. So our fixed assets would be the property, plant, and equipment. The fact that it says net means we're talking about after the accumulated depreciation. So the current value, and I don't mean market value, but the current carrying value of those fixed assets divided by the long-term liabilities. So when we talk about long-term liabilities, mostly we're talking about the content that we talked about in chapter 11, which is corporate bonds. We know that that's the primary source of long-term borrowing for corporations. They could also have some other long-term debt, such as mortgages, but primarily we're talking about corporate borrowing there, bonds. So you may want to make a note of that calculation. Before we go to the exercise, I want to go talk about the other ratios as well. The second ratio that we said we'd include in exercise 8 is the ratio of liabilities to stockholders' equity. As I said, this is also known as the debt to equity ratio. It's looking at what I refer to as the credit side of the balance sheet and looking at the relationship between our liabilities and our equity. This is a measure of how highly leveraged a company is, and I'll put that term on the screen in case you're not familiar with that. Whoops. L there at the beginning. So leverage refers to the amount of debt in the company's capital structure. The capital structure, remember we talked about in chapter 9 what it means to capitalize something. And to boil it down, capitalizing something means we put it on our balance sheet and we write it off over time. So we talk about the capital structure of a company, we're talking about its financing. Where does it get the money to do all of the operations of the company? And we talked about financing activities in the last chapter. We talked about the cash flow statement. So when we think about the financing of the company or the capital structure of the company, again, we're talking about where does it get the cash, the financial investment capital to run the business. And the more debt the company takes on, as opposed to bringing in new investors, the more risky that company is. Why is debt more risky than equity? Because you have to repay debt by definition. You've borrowed money, you have to repay it with interest. And so when we talk about the leverage of the company, we're talking about how much debt that company has. And as we look at this, the ratio of liabilities to stockholders' equity, also known as the debt to equity ratio, we are talking about overall for the company, how do their liabilities, which carry risk, compare to their equity? Some investors are interested in taking on ownership in companies that are highly leveraged, that have a lot of debt in their capital structure. And I'm going to give you just a very brief, simple example about why that might be the case. Why some investors might be interested in taking on a highly leveraged company as an investment, even though it's riskier. And the reason is because as an investor, we expect that with risk comes reward, that you're going to have the possibility of higher returns on your investment, even while you have the risk of greater losses as well. So here's my simple example. If you have a new project that you want to undertake and you think it might be pretty profitable, and so you borrow money for that project. And we know that when we borrow money, we have to pay it back with interest, as I just said a moment ago. So let's say, just for the sake of ease, let's say we borrow the money and we borrow at a 5% interest rate. It's 5 is a nice round number. So we borrow at a 5% interest rate. And that means that when we use the money, when it comes due, we have to pay it back with that 5% interest. So if the project returns 3%, in other words, we get a 3% return on our investment, how much interest do we have to pay back? We still have to pay back 5% interest, right? Because that's what we agreed to pay. So the investors lose out on that 2%. Because they borrowed the money, they have to pay back 5%, but the project only returned 3%. If the project returns 5%, what happens? Well, the interest on the borrowing is exactly covered by the returns from that project. But what if the project returns 8%? Now the extra 3% goes to the investors. What if it returns 10%? Now those investors get 5%. They didn't have to put any more money into the company, but they're going to make more money with no additional investment. What if the project returns 20%? Now the first 5% of that goes to pay back the debt, but 15% accrues to the stockholders with no additional investment on their part, because the project was funded through borrowing, the way I described it. And so that's why some investors who are not risk averse, so some investors are very risk tolerant, they're willing to lose their upfront investment, or part of it maybe, because of the potential for higher returns. So as we look at this ratio of liabilities to stockholders' equity, or the debt to equity ratio, we are looking just at the balance sheet, just at the credit side of the balance sheet, and saying how risky, how highly leveraged is this company? The higher the ratio, the more risky the company is, the more highly leveraged it is. And as I said, some investors are fine with that and other investors are not. So as we look at that exercise, our exercise 8, which is next, as we look at that exercise, it's going to be difficult for me to say, yeah, this is good or this is bad, because it is very much a subjective decision by each investor. How willing are they to take on that risk because of the potential for increased rewards? The last measure that we're going to be looking at is times interest earned, and this is an income statement measurement. All of the components that go into this calculation come from the income statement. So you can see that with these three measures, we are looking at balance sheet and income statement information to help us make some decisions about the company. You can see the calculation. The numerator of the calculation is income before income tax expense. And then we add back the interest. There's a special finance term acronym. We love our acronyms for that. And it's known as EBIT, which stands for earnings before interest and taxes. So the numerator is EBIT, earnings before interest and taxes, and I forgot to put the parentheses here at the end to close that out. So earnings before interest and taxes. The description that's given in the formula helps you to find those components on the income statement. We're going to start with the operating income, income before income tax expense, and then add back the interest, which is part of operating income. And then we divide by the interest expense. We express this as the number of times. And again, it's really a measure of the riskiness. We know that these are all solvency measures. It's a measure of the riskiness. How much earnings do they have coming in to pay their interest? The higher that ratio, the less risky the company is, the more likely that they'll be able to meet their obligations to make those interest payments on time. So let's go to exercise 8. Recent balance sheet information for two companies in the food industry, Mondelez International and the Hershey Company, is as follows, and these are all in thousands. So you can see that Mondelez is a much larger company. As we discussed last class when we talked about common size financial statements, just looking at the numbers that we can see on the screen doesn't really give us a sense of how these companies are doing compared to each other because the numbers are so different. And so if we were continuing to do an analysis of Mondelez compared to Hershey, we might want to use that approach of the common size financial statements, expressing things as percentages of the whole to see how the different categories relatively compare to each other across these two companies. Just as your review from Tuesday. But all right. So in letter A, it says determine the ratio of liabilities to stockholders' equity, what I have referred to as debt to equity. That's the more common name for that calculation. So we'll start with Mondelez. Now it tells us in 3 separate categories: current liabilities, long-term debt, and other long-term liabilities. So we're going to need to add those 3 pieces together to find their total liabilities. And then we want to divide that by their total stockholders' equity. And we're asked to round to 1 decimal place. So what did you get for that? Anyone get an answer for that? $1.4, that's what I got to 1.36 rounds to 1.4. Okay, go ahead and do the calculation for Hershey then. Again, remember you need to add together all 3 of the pieces of the liabilities that they have provided to us there. And then divide by the stockholders' equity. And so for Hershey, what did you get for their ratio of liabilities to stockholders' equity or their debt to equity ratio? Remember to round to 1 decimal place. Anyone get an answer for that one? 3.66, which would round to 3.7. So what kind of conclusions can we draw from that? Hershey has a higher debt to equity ratio. For every dollar in stockholders' equity, they have $3.70 in liabilities. Compared to Mondelez, which has only 1.4, $1.40 in liabilities for every dollar in equity. Hershey is much more highly leveraged. I can't say whether that's good or bad. I can say that Hershey is a heavier user of debt than is Mondelez, but if you're an investor, you may find Hershey then more attractive. Another calculation that would be helpful here is to see how their income compares to their interest expense. That times interest earned calculation would give us a better sense of whether Hershey's able to meet their debt obligations, to pay back the debt that they have borrowed. Let's do the second part here, the ratio of fixed assets to long-term liabilities. And so now we can see why the information was provided to us in the way that it was here. So we'll start with Mondelez. Back up here. And so 2 of these 3 categories are long-term liabilities. See, they have 14. Oops. See, their fixed assets are $8,733,000. And then the long-term liabilities, $14,207,000 and $7,669,000. And I got for that 0.399 or 0.4 rounding to 1 decimal place. So they have 40 cents worth of property, plant, and equipment for every dollar they have in long-term liabilities. And as we've said many times, I can't tell you whether that's good or bad. We need to compare it to something. And so go ahead and do that same calculation for Hershey. And so for Hershey, I got 0.49 or 0.5. I divided the total of their long-term liabilities, whoops, just that one, into their net property, plant, and equipment here from the top line that net means it's the carrying value, or it's after subtracting the accumulated depreciation from the original or historical cost. And so looking at that, those two ratios, what do we see? Well, Hershey has more fixed assets for every dollar of long-term liabilities than does Mondelez. So to answer part C, although Hershey uses more debt, we know that from letter A, it also has slightly stronger creditor protection because it has that higher level of fixed assets compared to their long-term liabilities. Again, it's impossible for us to look at this and say one is a better investment or a worse investment. We can talk about their solvency, but some investors are more interested in highly leveraged companies because of the magnification of the potential of that leverage to increase their ultimate returns. Any questions on that exercise? So as I said, it would be interesting for this exercise had they included the times interest earned calculation, because we can see how leveraged Hershey is. But it would be interesting to see from their income statement, because we have no information here about their income statement information. So it would be helpful to know how risky they are in terms of their ability to generate income to repay that interest expense. Moving on then to exercise 9, 6 measures of solvency or profitability. And I'm going to go back to. I'm going back to the PowerPoint to talk about some of these. Actually, before we do that, I'm going to ask you to do the first two calculations on your own. The ratio of fixed assets to long-term liabilities and the ratio of liabilities to stockholders' equity. I'm going to pause the recording and ask you to do A and B on your own, then restart the recording, and we will pick up with asset turnover, which is a new calculation for us. I'm going to pause the recording, restart after you've done A and B. Okay, so for letter A, I took the net property, plant, and equipment of 3.2 million and divided by the long-term liabilities of 2 million to get a ratio of 1.6. And then for letter B, I took the total liabilities of 3 million and divided by the total equity of 5 million and found a ratio of 0.6. And now we can go on with our new profitability ratios. So you can see, excuse me, a list here of the different profitability ratios. Some of these I would argue that the third column there, I would argue, are the market strength ratios that I talked about earlier. I'm not clear why they categorize them as profitability, because that's more related to the stock rather than the ownership, the operations of the company, but it is what it is. So we're going to start with asset turnover, which tells us how efficiently we are using the assets the company has to generate sales. You'll notice that we're going to, if we have any long-term investments, which I don't know that we're given information about that in this exercise. If we had any long-term investments, so remember those investments can be in financial instruments. So we might have, for example, a large ownership stake in another company, or that would be considered a long-term investment. Or we might have some property that we are holding and not currently using in the normal course of operations. We talked about both of those concepts in chapter 9 and then in chapter 13 when we talked about investing activities. So if we had any of those, we would exclude those from our total assets. And the reason for that is because those are not assets that are being used in the normal course of operations to help us generate income or to generate sales. And so when we talk about how effectively they're using the assets, we want to measure only the assets that they're actually using. And by definition, long-term investments are not being used in the normal course of operations. So there's our calculation for asset turnover. Let's go back to the exercise to calculate that. So we aren't given any specific information in the table about their assets, but it does tell us that long-term investments totaled $3 million. So they did tell us what the total assets were at the beginning of the year. They don't tell us the total assets at the end of the year, but we can definitely calculate that because we know that the total liabilities, whoops, there we go, just this, are $3 million and their total equity is $5 million. So given the fundamental accounting equation, if the liabilities are 3 and the equity is 5, the total assets must be 8. Of those 8 million, we're told that the long-term investments are 3 million, so we need to exclude that from our calculation. So here's our sales number. So asset turnover is our sales divided by the average total assets. So the assets at the beginning of the year were 7 million, of which 3 million were long-term investments. So the remaining, the operational assets, if you will, the assets being used in operations were 4 million. I'm just going to put the M there for million. And the operating assets at the end of the year were 5 million, as we already covered. And we want to average those together. So 18.9 million in sales divided by $4.5 million in average operating assets gives us an asset turnover of 4.2. What does that tell us? For every dollar we have in operating assets, we're generating $4.20 in sales. Is that good or bad? I don't know. We need to compare it to something. And in this exercise, they don't give us anything to use as a comparison. There is no rule of thumb for asset turnover because it's definitely different for every industry. So more helpful would be if we knew what industry this company was operating in, and we could look up the industry average to determine, are they being efficient and effective with generating sales using the assets that they have invested. Questions on that? So let me pull up return on total assets here. Oops, I thought I just did that. So our next calculation is return on total assets. How good are we at generating income with the assets that we have? How good are we at using the assets that we have to generate income? So you can see the calculation there on the screen. Again, net income, adding back the interest expense and divide by the average total assets. So with the information given in this exercise, there Net income. You can see right near the top of my screen, the net income for the year was $930,000. We want to add back the interest expense because that's been subtracted in the calculation of our net income. But if if we had not borrowed that money, if we had financed it through equity sales, we would not have had to pay that interest. So we want to add that back. And then we need to divide by our average total assets. So we already talked about the assets at the beginning of the year. We're told we're 7 million. We know they're 8 million at the end of the year. And so the average, I'm just going to, because I have limited space here on the screen, the average of 7 million and 8 million, of course, would be 7.5 million. And so our numerator, income, adding back the interest expense, and then divide by the average total assets. We express return on total assets as a percent. So once you have that value, you want to, of course, move the decimal 2 places to the right while you add that percent sign. It asks us to round to 1 decimal place. We don't really need to do that since it already was a whole number. So return on total assets, 14%. Is that good or bad? No idea. We need to compare it to something. We'd want to know maybe how does that compare to the industry average, or how does it compare to what they did last year or over some period of time. Everybody's good with that one? Let's go to return on stockholders' equity then. And so we've been comparing how are they using their assets to generate income, how are they using their assets to generate sales. In this measure, we're looking at how does their income compare to their average stockholders' equity. And the label on this is incorrect, so please disregard. That should not say that. It should say return on stockholders' equity. So that's an error in the PowerPoint. And so this calculation is looking at an income statement measure, net income, bottom line on the income statement divided by the average stockholders' equity. How good is the company at using the investments from their shareholders to produce income? Now, one warning or one reminder here, that average stockholders' equity represents the book value of the equity. It is not a measure of the market value of the equity. And so while this might be useful for comparison, if you are an investor or a potential investor in this company, return on stockholders' equity doesn't translate directly to your bottom line. Okay. So this is based on the book value of the equity. Remember, the contributed capital part of the book value represents the original or initial contributions, initial investments by the stockholders. And we hope, certainly as an investor, that the market value of the equity continues to increase. And that is not reflected on the company's balance sheet. So return on stockholders' equity. In the numerator, we start with the net income, which was given as $930,000. And the denominator is going to be their average stockholders' equity. And if nothing changed with their, I want to scroll up here. Okay, there it is. So that's what I was looking for. Did their contributed capital change during the year? And it tells us it did not. So the beginning stockholders' equity would be the 1 million for preferred stock, plus the 2 million for common stock, plus the beginning balance in their retained earnings. So we do have to calculate that. The beginning stockholders' equity was 1 million plus 2 million plus 1.57 million. So the beginning stockholders' equity was 4,570,000. Add that to the ending stockholders' equity of 5 million, divide by 2. And I found that the average stockholders' equity, if I scroll back down here, turn back on. So the average stockholders' equity was $4,785,000. We can divide that into the net income. And round to 1 decimal place. Again, just like return on total assets, return on stockholders' equity is expressed as a percent. So 19.4, rounded off to 1 decimal place, 19.4% return on the book value of the stockholders' equity. That does not mean that the return on investment here, if you are a stockholder, that does not mean that the value of your investment increased by 19.4% during the year. That's not at all what it means. It is strictly related to the book measures of net income and stockholders' equity. Doesn't mean it's not useful, but you need to be careful how you interpret that result. The last piece then, any questions on that before we move on to part F? So the last calculation we have here is return on common stockholders' equity. And so not all companies have preferred stock. We learned about preferred stock in chapter 12. So that's also included on this exam that you're going to be taking in the next week. Not all companies have preferred stockholders, but as we discussed in chapter 12, preferred stock has preference in a couple different important areas. Even though it's not voting stock like common stock is, it does have preference in receipt of dividends. And it does have preference if the company were being liquidated. So when we're looking at, as an investor, when we're looking at the returns for the company, we want to know, yeah, but how much of that belongs to me? How much of it is for me as a common stockholder? And so the difference that you see in this exercise compared, or this part F compared to E, is from the numerator, we subtract the preferred dividends. And from the denominator, we subtract the preferred stock piece of the equity, which in this exercise was, where is it? $1 million. And so our denominator is going to be $1 million lower. And the numerator, we start with, let me go back so I can put this on the screen for us. So the numerator starts with net income, which is that 930,000, as we know, but we subtract the preferred dividends. And the denominator, we're going to not include the $1 million worth of preferred stock. And so for the last exercise, the denominator was the 4 million, my calculator here, 4,785,000 in average equity. If we subtract the $1 million in preferred stock from the beginning and ending balance, that would give us 3,785,000 as our average common stockholders' equity. Remember, as we discussed in chapter 12, you know, the preferred stock looks kind of like a hybrid between stock and bonds, that it has that stated dividend rate, that the earnings are really capped for preferred stockholders. They're never going to get more than that stated dividend rate. But it doesn't have the advantage of bonds. It doesn't have preference over bondholders. If the company was being liquidated, yes, they get their money before the common stockholders, but the bondholders are above that as far as preference in liquidation. So 830,000 divided by 3,785,000 gives us a return on common stockholders' equity of, rounding to one decimal place, 21.9%. So if the return on all equity is 19.4, but the common stockholders' equity is higher than that, that tells us, of course, that the preferred stock returns must be lower than that. Right. So we can't really do any comparisons. We can't draw a lot of conclusions in this exercise. But keep in mind, of course, the point of doing all of these calculations is that we would then compare them to something else, whether it's how did this company do the previous year, or what's the trend over the last 5 years, or how are they doing compared to industry averages. We can't draw any conclusions from this exercise, but certainly that would be the purpose of doing any of these calculations, is to draw some conclusions to help us make decisions. Okay, questions on this exercise? Let's go on then to our final exercise for the semester. So just so you can see how well you're doing and how much work you've put in this semester. Remember, this is chapter 14. We've had 10 exercises for each chapter. So this is exercise number 140 for the semester. Add on top of that the problems that you've done. That's a lot of work that you have put into this class, and that's fantastic. I really appreciate that. Hopefully you have gotten something out of it and retaining something that you can take forward into the remainder of your time here at JCC, as well as beyond. Our last exercise then deals with what I referred to as the market strength information. I really question categorizing this as profitability, because it's really not profitability of the company. It's the returns for investors. But these are very important calculations, and especially if you are an investor, that's really where these are going to be important. So if the decisions you're trying to make are related to, should I buy stock in this company? Should I sell it? Should I buy more stock? Whatever. These are the calculations that investors, potential or current stockholders, would be interested in seeing. It's one thing to look at the income statement and know how much money the company made, but you want to know how much of that is mine. How much did they make for me based on my investment? And so the first calculation is earnings per share for the common stock. If the company only has common stockholders, this is a much simpler calculation because we just look at the net income from the income statement and divide by the number of common shares outstanding. If the company has preferred stock, though, we need to subtract the dividends from that net income, the dividends for the preferred stock, not the common stock. Because as we just reminded you, the preferred stock has preference in receipt of dividends. They get theirs, and then anything that's left goes to the common stockholders. So we look at the income statement to get the net income. We look at the cash flow statement to see the preferred dividends that were paid, we subtract those. And then we divide by the shares of common stock outstanding. If the number of shares of common stock change throughout the period, we would have to calculate a weighted average number of common shares. We don't have to do that for this class, but that is definitely how it would be done in a real world situation. The second calculation, well, let's do the earnings per share calculation first. Might as well. So we look at the company's income statement and we see that their net income was $1,750,000. And it tells us the declared dividends on the common stock. And it doesn't tell us, let's see, it doesn't give us a percentage for the preferred stock. Instead, it tells us what the dividend is. So the stated dividend rate for the preferred stock is this $4 right here. So the $4 per share. And doesn't tell us how many preferred shares are outstanding, so we're going to have to calculate that. $2,500,000 divided by the $40 par value tells us there are 62,500 shares of preferred stock outstanding. So if of the 62,500 shares of preferred stock, each one of those was paid a $4 dividend. That's $250,000 of the earnings of the company that went to pay the dividends for the preferred stockholders. Everybody good with that? Everybody, does it make sense? Everybody's okay with that? And so that leaves, we subtract that from the earnings, the net income of the company, that leaves $1.5 million for the common stockholders. And it doesn't tell us, again, how many shares of common stock there are, but it does tell us it's a $20 par value. So we can calculate the number of shares, $10 million in the common stock account divided by $20 per share. For the par value, that's 500,000 shares of common stock. So $1.5 million, there's $1.5 million in earnings after paying the preferred dividends divided by 500,000 shares. $3 per share. The earnings per share for the common stock, $3 per share. Is that good or bad? I don't know because I don't know how much the stock cost. I don't yet know. I know it tells us in the exercise, and that's going to come into our next calculation. So again, it's nice to know that our stock, our common stock, earned $3 per share, but is that worth it? Well, if you paid $3 a share and it earned $3 a share, that's fantastic. If you paid $1,000 for the share and it only earned $3, that's not a very good return. So the next calculation, the price to earnings ratio, off the screen, the price to earnings, or PE ratio, as it's commonly known. The price to earnings ratio is going to tell us, is it, now we know the earnings, which you'll notice is the denominator of this calculation, is that a good return on our investment? And the PE ratio is calculated, as you can see on the slide right now, the market price per share divided by the earnings per share. So we're told in this exercise that the market price is $45 per share and the earnings per share was $3 per share. 45 divided by 3 is 15. A PE ratio of 15 times earnings is the way we would read that. The PE ratio is 15 times earnings. The current price of the stock is 15 times the amount that the share earned in that year. PE ratios are really kind of divided into two different categories. We call them growth versus value stocks. And if you think about how that so if you think about how that is calculated. Oops. There we go. If you think about how the PE ratio is calculated, the market price in the numerator, the earnings in the denominator. A company that's brand new, maybe just getting started, is going to have lower earnings, right? Brand new company. And so the denominator would be pretty small. But if the company is highly touted, if it's expected to really be growing and doing great stuff in the future, then the market price of that stock might be pretty high compared to its current earnings. We think of that as a growth stock when the PE ratio is greater than 15, that's kind of the cutoff. And so a PE ratio of greater than 15 means we're buying future earnings. We're paying a little bit more for that share compared to current earnings because we think it's growing in the future. Compared to what we call a value stock with a lower PE ratio, where this is maybe an older established company. We don't expect it to grow a lot in the future, but it has pretty stable, steady, high earnings right now. And so the denominator would be relatively higher compared to the price. We'd have a lower PE ratio. Again, there's not one of these is good or bad. Some people are more interested in a growth portfolio where others might be more interested in a value portfolio. The pendulum swings over time. Which of these categories of stocks returns better? And so there is no one strategy that works under all circumstances and for all investors. But definitely the PE ratio is something that as an investor, you'd be interested in knowing where does this fit into my overall plan for investing? Make sense? Questions on that? Anybody? Let's move on then to our third calculation for this exercise, which is dividends per share. And this is a pretty straightforward calculation. How much dividends did we pay on the common stock? Remember, some companies pay no dividends. Some investors don't want dividends. And so if your company doesn't pay dividends, the dividends per share would simply be 0, right? And we divide that, whatever dividends were paid in total. We can find that out on the cash flow statement, as you saw in chapter 13. So whatever dividends were paid, we divide that by the number of shares of common stock outstanding. Again, if the number changed during the year, we'd have to calculate a weighted average for that number of common shares. And as long as we're here, I want to go, whoops, just change slides. Yeah, we can talk about that. I want to go to the final calculation, which is dividends yield, because there's a relationship. Once we know the dividends per share, we can divide that by the market price per share to find out our dividends yield, which is expressed as a percentage. As an investor, there are two basic ways that you make money by being invested in a company, in a corporation. One is through the receipt of dividends, but that's clearly not the only way you can make money because some companies don't pay dividends. If that's the only way you made money, you'd never buy stock in a company that didn't pay dividends. What's the other way we can make money? By being invested in a company. If the company doesn't pay dividends, how do you get a return on that investment? We talked about this in an earlier chapter as well, probably chapter 12. The price on that stock could go up, right? Cody, I think you're the one who said that maybe at the time. So the price on that stock can go up, and that's the other way you make money. So when we talk about the total return on investment, when you're invested in stock, this is one part of it, the dividends yield, which is expressed as a percentage. And then the other piece is how much did the price go up? Again, we can express that as a percent of the original price of that stock. And that's the, excuse me, the total return on your investment. The combination of how much did we get in dividends and how much did we make on the stock price changing. So let's go to our final two calculations here. Dividends per share. So the declared dividends on the common stock were $1,125,000. And we already calculated how many shares there were, but I can't remember, so I'm going to have to recalculate that. If there's $10 million in total par value, and that's $20 per share. So that's 500 total shares. And divide that into the declared dividends on the common stock. And I got $2.25 per common share were paid in dividends or were declared in dividends. To find the dividends yield then, as we saw, we take our answer to part C, the $2.25 per share, and divide that by the market value. That market value would be as of the last day of the year, last day of the fiscal year. And we express this as a percent, and we're asked to round to one decimal place. And so the dividends yield would be 5%. If the market value at the beginning of the year was also $45 per share, then the only return on this investment would be that 5% dividends yield. That'd still be a pretty decent investment. Of course, if the market value went down during the year, maybe it was $50 at the beginning of the year, and it went down to 45, that's a 5% decline. No, sorry, that's a 10% decline. And so you'd actually have a net loss on that investment. 10% decline in the price, add back the 5% dividend yield, you took only a 5% loss on that investment. A lot of people right now would be happy with a 5% loss in 2022. It's not been a good year for stock. Okay, so that is the end of our 140th exercise for the semester. With the remaining time we have in class, obviously, I'd be happy to answer any questions you have from this exercise. But anybody questions on anything? Questions from this chapter? Okay. So the other thing that I want to do is take a look at the practice set for exam 5. As I've said a couple times already, I would anticipate on Tuesday at our review session, we would look at this practice set because we do have an hour and 40 minutes. And these are brief exercises. That's what the BE means, in case you didn't know that. So the BE, beginning of these says these are brief exercises. On Tuesday, I would anticipate going through as many of these as, and you know what, 1 and 2 should not both be in there. Those are the same exercise. I don't know if I can't fix it now because people have been in there. So 1 and 2 shouldn't both be in there. That was a mistake when I made the set. So you can see that there is a scattering of exercises from all 3 chapters. Chapter 12, dealing with stockholders' equity. Chapter 13, producing a cash flow statement. And then chapter 14 that we've just done this week, doing some financial analysis using the information from the financial statements. So everything that's in this practice set, I would expect, is fair game for the exam. The exam So this exam has fewer questions than exams that we have had earlier in the semester, but it is worth the same. It covers 3 chapters and it is worth the same as any other exam. As with all the exams, the questions that take more work, so the ones that are exercises, are going to be worth more points. And a total of 50 points on the exam. So you've got a mix of multiple choice questions, which generally you should be able to read and answer those questions without any additional work for the most part. Some of these will require some work. And you've got exercises that are going to be a little bit more comprehensive, a little bit more work, and therefore a little bit more time and a little bit more in terms of the points toward the total exam. So exercises related to analyzing a company's financial statements. You can see here, there's an exercise where you need to do a full cash flow statement. That should be expected. Any questions about anything at this point? All right, I'm going to stop the recording.